from an investor perspective, what does an opportunity zone investment impact you and how can it benefit you? So again, this was the program is at a high level designed to stimulate investment in certain areas around the country, and we'll talk in the next presentation about how those were selected and why they were selected. But the main thing is that if you are a taxpayer and if you have capital gains, there is now a means by which you can take those capital gains, invest them into a qualified opportunity zone program, and get benefits of deferral of paying tax on those capital gains, a reduction in the amount of tax that you'll have to pay on the gains that you realized, and the big kicker on this is if that new investment does well and appreciates in value, all of the appreciation in value is also tax-free. And we're going to go through an example of how this works and the benefits that are there. So the gain deferral period, that 2026 date that Chastity and Wendy mentioned, is an important date because this is one of the things that actually is a contributor to paying for the tax cuts, right? And so in 2026, any tax that is owed related to the capital gains that get triggered that invests in a qualified opportunity zone, those are going to come due. So you are going to have to pay tax eventually on the capital gain. So it is different than like a 1031 exchange where you could roll that capital gain over and never pay tax on it if you kept into that investment. So there is going to be a tax due eventually here. But it is 2026, so you've got some time. So, if you made an investment in 2019, you'd have that 7-year deferral period where you'd have 100% of your capital gain working for you rather than the capital gain less the tax you paid today. And so clearly a big benefit there. The other piece is that there's a permanent reduction in the amount that you'll have to pay tax on. And so if you hold the investment in an opportunity zone for 5 years, you get a 10% step up in your basis. So your basis is basically zero because you haven't paid any tax on that. So if you had $1 million investment, eventually you would have to pay tax on $1 million. If you leave it in there for 5 years, you're only going to have to pay tax on 900,000 of that because you get a 10% step up in your basis. Then if you leave it in there for another 2 years, so 7 years in the aggregate, you get an additional 5% step up. So if you just think about that $1 million example, when you get out to 2026, you'd only be paying tax on 850,000 instead of paying tax today on $1 million. So clearly a benefit there. You're going to save at the roughly 25% cap gains rate plus net investment income tax. On the 150,000, you're basically saving about $40,000 plus the time value of that money, right? Because you would have to pay that tax today without this opportunity, but you won't have to pay it until in 2027. So a great benefit that from the deferral piece. Now, the real big kicker again that I mentioned, so if you keep your investment in that opportunity zone for a period of 10 years, so you do have to lock up the investment for 10 years, but if you keep it in there for a period of 10 years, at that point in time, when you sell the investment, you get to elect to step up the basis in your asset to then current fair market value. So if that $1 million investment that I talked about turns into $2 million, you make an election in year 11 when you're going to sell that investment to step your basis up, and none of that $1 million appreciation would get taxed then. So very powerful program from that perspective. You can see in the normal setting, and we'll run through an example here of how that works in just a couple minutes. But you really end up paying tax on only 85% of the initial gain rather than 100% of the initial gain and 100% of the appreciation in value. So there are some critical things about the investments related to opportunity zones. You only have 180 days from the date of the triggering event to make an investment in a qualified opportunity zone. So there is some time sensitivity to it, right? Now, the rules that did come out recently, though, gave us some relief on that, and they said that if the shareholder or the member of a company is going to get that gain flowing through to them, there's really 2 periods that get to make the election. One, the entity, so if you sold an asset in a partnership, for instance, the partnership could make the election within 180 days to take those dollars and reinvest them into a qualified opportunity zone without having to pay tax. But if the partnership doesn't make that election, then you as an individual get another bite at the apple. So when that gain flows out to you on a K1, so effective 12/31 of the partnership's year end, and now it becomes your gain, now you have an additional 180 days to make that election. And so really effective January 1st through June 30th of the subsequent year, you would have the ability to make that election. So there was a lot of concern that there were gains that were getting triggered in early 2018, and because we didn't have the regulations out on this, we were going to miss out on the ability to take advantage of this. This provision that allows the individual to look at that in, basically the first 6 months of 2019 now, is really how that was captured, and Treasury tried to solve that problem. So a real favorable thing that did come out in the regs, the proposed regs that came out in October related to this. So this is just an example of what we talked about. Again, and we're using here a $20 million gain that we're going to defer. You get a step-up basis in year 5 of 10%, so now that gain goes down by $2 million. In year 7, it goes down by another $1 million. And then if that number goes up to $30 million, and what we're going to do is just show you a quick example of that. So the original gain you would have paid tax on, $20 million, roughly $5 million in tax. Under the opportunity zone, you're only going to pay tax on $17 million, so roughly about $4.2 million in tax. So there's about $800,000 tax savings in that scenario. Then on the back end, you would pay tax on the $10 million gain, right? So you'd pay another $2.5 million of tax on that. Under the opportunity zone, you're not going to pay any tax on that gain. So just in that simple example, you can see that you're basically saving $3.3 million in tax on a $30 million investment. So roughly 10 or 11% in tax on the ultimate amount that you would realize. So you can see the power of something like this. And the numbers that we're looking at here are really kind of real estate related numbers, going from a $20 million to a $30 million number. You think about this, and the venture capital community is very excited about this, because think about the multiples that VC firms get. Now, not many VC firms actually hold an investment for 10 years, but if you had a venture capital investment and it went like a 40 times return on your money, think about some of the folks that have, stock in Facebook and others. That could be a real powerful tool for the venture capital community if they deployed these types of dollars. So if you get into a venture capital fund that like this, and they have those kinds of significant returns, very powerful tool on that side, because the numbers on the appreciation are astronomical. Quick comparison of the benefits of 1031 versus opportunity zones. And you can see that there are a lot of positive things. So the biggest one that I like is that if you've ever done a 1031 exchange, so in that case, if you sold a property for $1 million, and let's say you had a $250,000 gain on that, in order to defer the tax on that, you would have to reinvest the entire $1 million into a new property. Using an opportunity zone, you get to create liquidity for yourself. You would get to keep your $750,000 basis and only have to invest the $250,000 gain in order to do that. So particularly for folks that are kind of starting out in their careers and they need that liquidity and can't afford to wrap it all up in a new investment like that, this does afford a great opportunity. Now, the downside is obviously there's limitations on where you can invest. And in the next presentation, we're going to talk a little bit about how those zones were identified and everything. But there are limitations on where these projects or businesses or properties can be. So, overall, though, the point of this is if you have capital gains, or if you have capital gains currently locked up in your portfolios, this represents a great planning opportunity. You should be talking to your wealth advisor, your tax preparer, on what can be done to help you systematically unlock those gains, diversify a little bit, and do it in a very tax efficient manner.